Hello there, today we will talk about the revenue recognition principle. It is a principle that ensures that the reported performance of an entity reflects true extent of revenue earned during a period rather than the cash inflows generated. So, first of all, to discern and more easily understand the definition of the revenue recognition principle, I will ease you off by defining what is revenue. Revenue is an increase in resources resulting from the sale of goods or the provision of services. For example, receiving $80 for mowing a lawn. Since you will have $80, so now we can go back and ask, so what is revenue recognition principle? Aha! It is a principle that revenue should be recorded when a resource has been earned, and not just when the cash is received. So now we're moving on to examples. So for example 1, Bob orders apples from Jenny, the woman to the right, paying her on the same day, which is the 15th of March. Then 3 days later, on the 15th of April, he comes back to collect the apples that he has ordered. In this scenario, the revenue is recorded for the month of April, the second month. So in this scenario, this is a deferred revenue. So a deferred revenue is when cash is received before revenue is earned. To illustrate a more detailed example in a deferred adjustment, suppose a company sells 12-month subscriptions to its monthly magazine. On the 1st of October, the company receives a total of $1,200 on 20 subscriptions. As shown here, there's a credit cash and debit unearned subscription revenue. Suppose further that the company prepares financial statements at the end of each month. As of 31st October, the company has provided 1 month of magazines and has therefore earned 1 month of revenue. Since the accounting system does not yet reflect this earned revenue, the following adjustment entry should be made. So now for example 2. On the 25th of April, Bob helps the man Tim, the man in a blue shirt on the left, to mind his house since he's going overseas, where Tim promises to pay him when he comes back. 3 days later, Tim arrives home and thus pays Bob for his service. In this scenario, the revenue is recorded before cash is paid. This is an accrued revenue. An accrued revenue is when cash is received after revenue is earned. Now to illustrate a more detailed example in an actual revenue adjustment, suppose an accounting firm agrees to provide a service to a client for a $1,000 fee. The firm completes its work on 21st of September, bills a client on 10th of October, and receives payment on 21st October. Now in terms of the accrual basis, the accounting firm must record the $1,000 of revenue on 30th of September. An accrued revenue is when cash is received after revenue is earned. Thanks.
Created using Powtoon.